question very carefully, okay, and understand it. Fine. So there is a company called XYZ Limited, a US firm, will need 3 lakh pounds in 180 days. In this connection, the following information is available. Of course, this question was slightly complicated. I made it very easier because this came in CA final and I changed a bit. The spot rate of 1 pound is 2 rupees, $2. Okay. The rate today is around 1.2 or something, but this is a. बेटा मैं लेक्चर ले रहा हूँ. आ गए थे पैसे उसे लैंडलॉर्ड से. Okay. So suppose the pound rate is equal to $2. Okay. It keeps changing, but of course it was quite long back when 1 pound was equal to $2. But currently, if you check, it was 1.2 or 1.3 because the pound is 110 rupees something and the dollar is 86. So it will come out to 1.2. So spot rate 1 pound is equal to $2. Okay. 180 days forward rate of pound is 1.96. Okay. Interest rates are as follows. Okay. Now interest rates are given at the bottom. Okay. So I have to this thing. A call option of pound that expires in 180 days has an exercise price of $1.97 and a premium of $0.4. Okay. So you can take a call option. You can take a forward contract also is given, rate is given, and the interest rates are also given. Okay. Expected spot rate after 180 days is $2.05 per pound. Okay. Interest rates are given in UK as well as US, both are given. Now, what is the task? Which of the following strategies should be most preferable to the company? Forward rate, forward contract, money market, no hedging, options contract. Okay. Now, just follow and understand. Okay. I'll just share the slides. Don't worry. Forward contract approach, which is very simple and straightforward. You have to pay how much? 5 lakh pound. First part should give you full marks, and even no hedge should give you full marks. So 3 lakh pounds is payable after 180 days. What is the rate? 1.96, which is the given in question. 1.96 is the forward rate. So here straight away multiply because the rate is given 1 pound is equal to $1.96, and that is the rate what you are looking because you are actually booking you want to buy pounds, and the rate is also given in the right way. Okay, this rate is 1 pound is equal to so many dollars. Okay, and that is what you are looking for. Fine. Now how much would be 3 lakh pound? You just multiply that. So it will be $5,88,000. So the first part is solved. Okay, fine. Now if you just straight away go to first no hedge approach. Okay, X Limited wants to buy 3 lakh pounds as the expected rate after 180 days is 2.05, which is more. So if you apply this, so it will be $6,15,000. So if you go to the forward rate, it was how much? 5 lakhs. So the forward rate looks to be a better rate compared to no hedge because the dollar rate has gone up. Okay. So pound has actually appreciated. So you are losing money, isn't it? From 1.91 pound is equal to itna. So pound has appreciated. So you are losing money because of that. And you have to pay in pounds. So if the pound appreciates, you are going to lose more and more money. As we see, the pound is appreciating from 1.96 in the forward market to 2 point something. So you're going to lose in a no hedge situation. Okay, that's the expected rate. So you expect that rate to happen. Okay. Now in a money market, since you are what? You are an importer. Okay, because you have to pay in pounds. Okay, let's go back. Is a US firm needs pound. So you need pound and you are in USA. Okay, fine, and you are an importer. So if you are going to pay pounds, so what you do, what you have to do is basically borrow the dollars because you are going to pay, the money in pounds. So borrow the dollar, convert to pound, and invest and repay the loan. That is what you are going to do. Okay, you are an importer. Your money has to flow outside. So you borrow in home currency in dollars and convert them into pounds and take it to America and invest there so that it pays off your liability. So that is what we did. Okay. So amount of pound to be invested would be, now first you have to look for the reverse gear, that how much you are going to invest in England. Okay. So how much you have to pay? 3 lakh pounds divided by the interest rates, which is 1.05, and it is the rate which is given there. Okay, so that means this much of money you should be borrowing in England. Okay, fine. Fine. So only thing is that you should look here the rate. So you are going to deposit this money where? In England, isn't it? You are going to borrow and invest in England. Okay, fine. So the rates are given to you. Okay, deposit rates and borrowing rates are given UK and US. Okay, fine. So you need to deposit the money in UK, isn't it? So rate is 4.5%. Okay, 180 days rate is given. Fine. It is not per annum. 180 days का रेट दिया होगा. अभी आपको उसको आधे से डिवाइड करने की जरूरत नहीं. It's not per annum rate. That's why I gone there. Okay, because I didn't check that. So it's 180 days. So you don't have to do it division by 2. ये आपको 180 दिन का रेट इंटरेस्ट दिया होगा. ओके, सो गो टू दिस. Okay, so that means amount of pound to be invested will be 3 lakh divided by 1.045. So that means how much you are going to invest? 2,87,000 pounds. Fine. So that it grows and you can pay off your 3 lakh pound liability. Amount of dollar needs to be converted into. So it is 2,87,000 multiplied by 2. 2 is the spot rate today. Okay. So this much of dollars you are going to get, isn't it? Fine. So you borrowed the money, took the money in America in dollar terms. So in dollar terms it was 5,74,000. You applied the spot rate, and this was the money which was available, and this is the money which you borrowed in America. Okay, isn't it? That's the first time you have to borrow in America. So interest and principal on dollar loan after 180 days will be 5,74,000 into 1.055. So this is the borrowing rate in America, 5.5. If you go back and check, so that means you have to pay 6,05,000 in terms of dollars. So now you have 3 rates: no hedge, forward, and money market. So you find forward rate is the best so far, 5,88,000. These both rates are above 6 lakhs. Okay. So now we come to the last one, the most trickiest part, which is the options. Money market, if you understand, and you can do it so easily because it's just a calculation. Okay. So in the option you have chosen an option contract. Okay. So XYZ Limited buys a call option to hedge against unfavorable exchange rate movement. Okay. He pays, now he is going to pay a premium. Okay. What he is going to do? He is an importer, exporter. He is an importer. So he is going to buy a call option, which I have not written, but you can understand. You can always mention that he is buying a call option. So he pays 4 paisa per pound. So that means he has to pay $12,000 as premium. Okay. He pays a premium of how much? $12,000, which is 4 paisa per pound. Okay. Fine. And how many pound? 3 lakh pound. So this money will straight away go from his pocket. Okay. The moment he enters into option trade, he has to pay the writer 12,000 pounds, $12,000. Okay. This is an upfront money he is losing. Now, spot rate. Now the spot rate closes above at 2.05 as he. Now the spot rate is, suppose the expected rate was 2.05, which I mentioned the question. The rate closes at that rate. Assume that the rate closes at that rate. Now, which means the rate has gone up and he is making money because he has bought it at 1.97. What was the strike price? 1.97 was the strike price. If you go back and check 1.7. So the rate has gone up to 2.05. He is sitting on a profit in a stock exchange. He will exercise his option. In case it has gone down, he will not do. But now he is going to exercise. Okay. So his gain is how much? 2.05 is the current rate, expected rate. Assume that this rate, this was the spot rate on that day. Okay. You have to make an assumption that the dollar closes at this rate. Okay. So 2.05 minus 1.97. So that means he is sitting on a profit of 0.08, dollar per pound. So which translates into a profit of $24,000. Is that okay? So he's going to get $28,000 from the market minus 12,000, which he has paid a premium upfront. So his net gain is how much? 12,000 pounds, isn't it? 12,000 डॉलर का उसको फायदा हो गया. So net gain is 12,000 pounds. Okay, but this is the money he is going to get from the stock exchange. But when he goes to the market, okay, he pays to his banker how much? The rate was 2.05. That was the expected rate. Suppose this was the rate available on that rate that day. So he has to pay the banker 6,15,000. But net amount will be only 6,03,000. Because here he has gained a gain of the stock exchange, $12,000. Okay. And when he paid to the banker asked him lot of money. He says the rate is 2.05. So to the banker he paid 6,15,000. From the stock exchange he got $12,000. So his net outflow was 6,03,000. Now here there is one more catch here, that the premium is paid upfront. Okay, and the money which is going to get from the stock exchange, it will be after 180 days. How much? 24,000. So to just make a little bit more better, apply the interest rate which he is going to lose on that 12,000, and then calculate how much money he is going to make. So 6,03,000 is without calculating any interest. Fine. If you are doing a CA problem, CA question, then you have to add the interest. Okay, but here you can just ignore that. Okay, so he says that he is going to, because 12,000 premium he has to pay the writer upfront. 180 days before when he started his contract, he paid $12,000, and that money remained, invested for about 6 months. Then he got his 24,000. So 12,000 पाउंड के ऊपर आपको जो रेट ऑफ इंटरेस्ट है, रेट अमेरिका का रेट है, वो लगाना पड़ेगा. Okay, to calculate exactly how much he is making again. That's the opportunity cost to him. Okay, so that means the cost is $6,03,000. Okay, so now if you make a comparison, forward rate was 5,88,000, money market 6,05,000, options contract 6,03,000, and no hedge 6,15,000. So forward contract is the cheapest. Okay, so now here also you can just solve it like this also without going into all calculation. Exercise price is how much? 1.97. What is the premium? 0.04. Assume that his exercising is right, so this will become his cost of hedging. So it will be 2.01 multiplied by 3 lakh, you straight away get the answer. Instead of doing all that calculations, you can just even do this when he is exercising, because here he has to exercise because the rate has gone up. Assume that the expected rate has become the real rate, so he will have no choice but to exercise. So the exercise rate 1.97 plus the premium will become his cost of dollars. You multiply it with 3 lakh pound, you will straight away get the answer. But in reality, this is the way we look at. In stock exchange, you are not going to get pounds, okay, or dollars. Okay, so here you are going to get some money from the stock exchange, go to the bank and pay him for the money to convert your pounds into dollars. So that is what he has done. At 2.5 he paid to the bank, and from stock exchange he got 24,000 minus 12,000 premium. So that was his net gain. So if you add less both the things, so his net outflow was only $6,03,000. Okay, so which is basically a very shortcut manner. This is like this. Most of the CA questions are solved like this. When you ask them how you have arrived, they will not have any answer for that, because the long calculation is shown at the last slide. That is the right way of doing it. Okay, but they don't understand that. Is that okay? Is it clear? समझ में आ गया? Options वाला भी समझ में आया जो मैंने calculation दिखाई थी. Now I'll just to again summarize what happened in the options this thing. So let me just put the rates here. Okay, so that requires an more explanation. Okay. मनी मार्केट में कोई प्रॉब्लम नहीं है, सिर्फ प्रॉब्लम है ऑप्शंस में, isn't it? So I'm just going to explain that on the board. Okay, so let's go to the question first. Now a call option, he's written call option is written actually, a call option. So he is what? He is a importer. Okay, for him the call option is the answer. if you are an exporter, then you have to buy a put option. Now, if you are an importer, okay, you just take the opposite, of what you have in the real market. In the real market, if the dollar goes up, you lose money because you have to pay more dollars. But in the stock exchange, you're just taking the opposite position. What do you have the position in your real market? In real market, you are short of dollars and you're taking a long position in the options market. Here, you're going long on dollar because you are buying call. If you think the dollar will go up, you're going to make money. But your actual position is that you have to pay to someone dollars, okay? And if the dollar goes up, you're going to lose money. So you are short in your actual position, but you're taking a long position in the options market. Similarly, you do in the futures market also. So you're taking a call. So you make money only if the dollar goes up. If the dollar goes up. If the dollar goes up, you make money. Okay? Fine. So here, the exercise price was 1.97. If you look at the price, it was 1.97 dollar per pound. This was the rate of this was the strike price. This is the strike price he has chosen. He is betting on this price and he is paying a premium of 0.04 dollar per pound. Okay. He says, I'm ready to pay this premium, but this is going to be my rate. Okay. Fine. Now, if the dollar goes up, suppose the dollar goes to 2.05. Assume in the question it is written 2.05 dollar. Okay. So the dollar has gone up. Okay. He is a happy man. He is sitting on a profit in his position. How much? Difference of the two. How much it comes to? 0.08. Sorry. He is making a gain of 0.08. The difference of this. Okay. Minus this, he is sitting on this gain. Multiplied by how much? 3 lakh pound. Which comes to $24,000. Okay. But he paid a premium which was $12,000 upfront. Itna premium dena pada. Okay. So this is his minus position and this is his plus position. So his net position is, net gain is how much? 24,000 minus 12,000, which is 12,000. So he is sitting on a gain of 12,000 rupees by taking this position. If he exercises call option. Okay. If he exercises call option. Now in the question the rate is not given, it is in the expected rate. You are assuming that the rate has gone up. Okay. But you can always, if you understand well, you can say even the rate goes down, then in that case he is not going to exercise his call. Okay. He is going to lose the premium. Okay. And then you have to assume another rate, that suppose the rate has gone up to $1 is equal to, sorry, 1 pound is equal to say 1.90 or say 1.80 dollar. Suppose this was the rate on the day. Instead of going to 2.05, the rate actually closed at this. He is not going to exercise his call option. Why should he? He's getting a better deal here. He'll go to the market and buy at 1.80 rather than buying at 2.05 in the market. So then he's going to lose that 12,000 premium and pay at 1.80. Then the calculation would be different. Okay. So if you understand well, then you can have two assumptions. One assumption is that if the rate goes up, he is going to exercise the option. Suppose it matches his expectation, then the profit is, then his outcome will be, which is I have shown. Okay, the total, the profit is 12,000 plus the rate of 2.05 multiplied by 3 lakh pound. Add them both, you get a total. Rather here, what we have to do is there is a profit here, isn't it? यहाँ profit हो रहा है ना. हाँ, तो माइनस करना पड़ेगा ना. जो प्रॉफिट है 6,15,000 में से माइनस 12,000 करना पड़ेगा, बिकॉज ही इज पेइंग एट अ हाई रेट माइनस द ऑप्शन contract profit. So that means his net outflow will be 6,03,000. But in case the rate had gone down, he is not going to exercise his option. He is going to lose the 12,000 premium upfront, which he is paid. He will lose and go to the cash market and buy dollar at that rate. Suppose assume it is 1.80. Then do a calculation and show that also in your answer. In your case study, you can show both things. In my solved case study, I have actually given this answer to them. But even if you do this, I don't think Ashish is going to deduct marks. Is that okay? Have you followed this? Any questions, please? आज के कम स्टूडेंट हैं 1 2 3 4 5 6 7 8 you said 45 students but they are very less. This is very